Welcome back to Massfield. There are a few tax changes coming up this year that might just affect your future financial planning. And Dylan Bond, he's the owner of Bond Financial Services. He's here to keep us on track for a healthy retirement. Dylan, things are changing a little bit in this tax season. So basically, if you make over $400,000 a year, your whole household, there are some changes you need to be aware of.
Right. The bottom line is if you make over $400,000 a year, your tax rates on dividends are going to go up from 15% to 20%. And conversely, if you make under $72,000 a year as a married couple, then you're still going to stand in that no tax area.
A lot of people think, $400,000, that's a tremendous amount of money. But when you start adding things up in addition to your income, it adds up pretty quickly.
It does. And really the bottom line is it's a case-by-case basis. You really have to take the time to sit down with someone and figure out where their income sources are coming from. Is there anything that they can do to drop their taxable income to a lower level so that maybe their tax bracket goes down, even if they're not making over $400,000? Our tax laws have different series of tax brackets. So the more money you make, the higher tax bracket you go in. And when you get to retirement especially, you have the ability to manipulate how much money you take out in any given year that you might be able to drop into a lower tax bracket.
And that's why when you're thinking about how you're going to construct your income in your retirement planning, you need to put a bunch of money away into more or less two distinctions. There's money that you invest in that gets taxed immediately, and then money that's tax deferred.
Yeah, actually there's three buckets in my opinion, and the first is tax deferred money. That's going to be your IRAs, your 401ks, your 457s, TSAs, things like that. That is money that you don't pay tax when you put it in. It grows tax deferred, and when you take it out, it's all taxable at the time you take it out.
So in other words, when you're putting it in, you're getting more and more money because it's before tax money, but then you're getting hit with that tax time bomb when you take it out.
When you put it in, you're actually getting a reduction in your taxable income for the year because obviously the money you funnel to those types of accounts is not taxable that year.
Oh, so let's take it through then for someone who might not be able to figure it out. So you make $100,000 a year, but you put $30,000 a year away into your 401k. Just rough math.
Okay.
Basically, then your taxable income is only $70,000.
It would go down to $70,000, yeah, in general terms. And again, what you really have to do is sit down and weigh your own situation because everybody out there is different. And it's important also that you get a tax professional involved, especially when you're starting to talk about $100,000, $200,000 a year, because they can also offer some good guidance on where you stand from a tax standpoint, and then we can work with that advisor as well as the client and help them find ways to position their money a little bit more tax efficiently.
So Dylan, there's the 401k, and that's the money that you put in, and that's before taxes, and then you get hit with that tax time bomb at the end.
Right.
Tell us about the other side of the spectrum. What's the money that you put in after taxes?
Well, there's two ways to look at that. There's non-qualified money, which is money that is not in any type of IRA. It's just the money that you pay tax on and you save or invest, and you pay tax on the distributions or interest that you earn on that money year after year. Then there's Roth IRA money. That's money that you pay tax on up front, then put it into the Roth IRA, and then down the road when you turn 59 and a half or older, you can take all that money and all the growth of that money out tax-free.
Which is nice. So what's going to happen, in other words, then you'll have some money where you hit the tax time bomb, some where you don't, and it evens out in a sense, so that when you're planning for your retirement, you're not going to have any last-minute surprises.
Yeah, actually, if you're younger out there and you're looking to accumulate some money for retirement, the thing to think about is try not to have all your money in one type of account, like a tax-deferred account. I see people now that have worked for 35, 40 years and did all their savings in 401k plans, and when they come to me and they're getting ready to retire, they have no other savings outside of the 401k, so all of that money is taxable. So the problem there is if they wanted to buy a car or do something with that money, they would have to take all that money out in a lump sum or whatever money they needed in a lump sum, pay income tax on that money above and beyond the income they need to cover their expenses. It could drive them up into a higher tax bracket. To give you, using your numbers, a $100,000 withdrawal from a 401k in a 25% tax bracket, that means they would have to pay $25,000 in tax, so they'd only end up with $75,000.
You could be in a little bit of trouble there.
You can be in trouble, and you got to be very aware of that.
So that's why people can start playing now. The other reason, too, is if you put all your eggs in one basket and that basket falls over, maybe the market dips, you're in trouble.
That's right.
Now, Dylan, it's a pleasure to have you here. And if people want to see you more than just Wednesdays at 11 here on Mass Appeal, they can see you on the golf course or at restaurants because you do some talks.
We try to do a seminar every week, and really all I'm trying to do is get out in front of people, tell my story, talk about things I think are important to people at or near retirement, and give them the opportunity to say, well, does it make sense for me to sit down with Dylan and go over my personal situation, or is it not for me? And what I find is a lot of people decide to come and meet with me, and that's all I'm looking for, is an opportunity to help people.
You might be able to make their lives a little bit easier, so you can visit bondfinancialservices.net, or you can give them a call, 413-754-4747, and just let Dylan and his staff take the steps to secure your financial future.